My biggest trading disasters didn't arrive as sudden explosions. They arrived quietly disguised as confidence momentum and the comforting belief that this time I finally understood how the market worked. That's the part most people don't want to hear. Disasters are rarely caused by ignorance. They're caused by partial understanding mixed with oversized conviction. I've lived through enough cycles now to know that every major loss I ever took was preceded by a period where things were working just well enough to make me stop listening, stop questioning, and stop respecting risk the way I should have. The first disaster that truly reshaped me happened during the dot-com era. Back then, you didn't need a thesis, you needed a ticker with .com attached to it. Prices went up every day, analysts sounded brilliant, and the market rewarded speed and confidence far more than discipline. I wasn't reckless in the way beginners are reckless. I had rules. I sized positions. I thought I was careful. But what I didn't realize was that my definition of careful had quietly expanded to fit the environment. I started holding winners longer than my plan allowed because they kept going up. I started giving losers more room because everything is volatile. Those were small adjustments that felt reasonable in the moment, but they were cracks in the foundation. The real disaster wasn't the eventual crash, it was how exposed I was when it came. When liquidity dried up, exits vanished. Positions that had looked manageable became traps overnight. I remember staring at the screen, watching bids disappear, feeling something I had never really felt before in markets helplessness. Not fear, helplessness. The realization that skill doesn't matter if you're positioned for the wrong environment. I lost a painful amount of money, but the deeper loss was confidence, because for the first time I couldn't explain the outcome by pointing to bad luck or external events. I had to admit that my discipline had been conditional, and conditional discipline is no discipline at all. Recovering from that wasn't about making the money back quickly. That urge nearly finished me off. The real recovery started when I forced myself to stop trading for a while and review every decision without excuses. I looked at position sizing at where I moved, stops at where I violated my own rules, and told myself a story to justify it. The hardest part was realizing that my biggest enemy wasn't volatility, or the market, it was my willingness to bend when things felt good. That insight stayed with me long after the losses faded. The second major disaster came years later, leading into the 2008 financial crisis, and it was different in a more dangerous way. This time, I thought I was experienced. I had survived one crash. I believed I understood risk. That belief made me arrogant in subtle ways. I saw the cracks forming in the system early. I understood leverage housing derivatives. I was right about direction, and that was the trap. Being early and being right are not the same thing in markets, and I confused the two. I positioned myself aggressively for a collapse that took longer to arrive than my patience could tolerate. As the market chopped and rallied against my thesis, I did what many smart traders do. I averaged. I added. I told myself the fundamentals hadn't changed. On paper, I was correct. In reality, I was fighting liquidity and time. When the real breakdown finally came, I should have been positioned to benefit calmly. Instead, I was emotionally and financially depleted from months of pressure. I made money on the crash, but nowhere near what I should have, and the stress nearly broke my decision-making at the worst possible moment. That was a different kind of disaster, not a blow-up, but a failure to capitalize on being right, because I had paid too much in advance. The recovery from that episode taught me a lesson I still live by. Markets can stay irrational longer than you can stay positioned. Risk is not just about direction, it's about duration. After 2008, I changed how I structure trades around uncertainty. I stopped trying to be the hero who sees it first. I learned to scale, to wait for confirmation, to respect the cost of carrying a position emotionally as much as financially. That shift didn't make me faster or bolder. It made me calmer, and calm is an edge that compounds. The third disaster during the COVID era was perhaps the most humbling, because it came after decades of experience. By then I knew better, or at least I thought I did. The speed of that crash was unlike anything I had seen. Correlations went to 1. Liquidity vanished in places that were supposed to be safe. I wasn't over-leveraged, but I was overconfident in my assumptions about market plumbing. I trusted that certain exits would always be there. They weren't. I took losses not because my thesis was wrong, but because my model of how markets function under extreme stress was incomplete. What saved me this time wasn't brilliance, it was humility. Learned the hard way over years. I cut risk aggressively. I went smaller than felt comfortable. I accepted slippage without fighting it. I prioritized staying operational over being clever. Many traders around me froze, argued with the tape, or tried to trade their way out emotionally. I stepped back. That decision preserved capital, and just as importantly, preserved clarity. And clarity is what allowed me to re-engage later, when conditions stabilized and opportunity became real instead of frantic. Looking back across all these disasters, a pattern becomes obvious. Each one was preceded by a period where I thought I had something figured out. Each recovery began the moment I admitted I didn't. The market has an unforgiving way of reminding you that confidence must be earned every day and never carried forward unquestioned. Experience doesn't make you immune to mistakes, it just changes the price you pay if you're willing to listen. And this is where the story really needs to continue, because the most important part is not the disasters themselves, but the specific habits, rules, and mindset shifts that allowed me to rebuild trust in my own decision-making afterward, and eventually trade with consistency again. And that recovery process is not dramatic or fast. It's quiet, methodical, and often uncomfortable. And understanding it is far more valuable than hearing about any single mistake, because that is the part you can actually apply when your own trading goes off the rails, and you're standing there wondering whether you can come back from it, or whether this loss defines you and ends your journey. And that question is exactly where we need to go next. As this sentence carries forward into how recovery really works in trading, and how to rebuild discipline, confidence, and edge after things fall apart, and you're forced to confront yourself honestly. Because recovery in trading has very little to do with making the money back, and almost everything to do with rebuilding trust in your own decision-making. The first thing I had to accept every single time was that confidence is not restored by winning trades. It's restored by keeping promises to yourself. After each disaster, I stripped my process down to the simplest possible rules and followed them religiously. Not because they were perfect, but because they were clear. Small size, fewer trades, defined risk, no improvisation. When you've been shaken badly, complexity becomes dangerous. Recovery starts with boredom, not brilliance. One of the hardest steps was slowing down enough to separate damage from identity. Big losses have a way of making you feel like the loss is who you are, not something that happened. That emotional fusion is lethal. I learned to step away from the screen and review trades as if they belonged to someone else. No excuses. No self-attack. Just facts. Where did I break my rules? Where did I size emotionally? Where did I confuse conviction with patience? This kind of review is uncomfortable because it removes both blame and drama, but that discomfort is where clarity returns. Another critical part of recovery was redefining what good trading meant for a while. After a major drawdown, good trading is not making money. Good trading is executing cleanly. It's taking a loss exactly where you said you would. It's not taking a trade when conditions don't meet your criteria. even if the market moves without you. I measured progress by discipline, not P&L. Ironically, that shift is what eventually brought profits back, because consistency is the soil profits grow in, and you can't rebuild that soil if you're obsessing over results. I also learned to rebuild confidence gradually through constraint. I limited the number of trades I was allowed to take. I capped daily and weekly risk at levels that felt almost too conservative. That wasn't fear, it was rehabilitation. Just like an athlete coming back from injury, you don't test maximum strength on day one. You restore form first. Each week of following rules without incident rebuilt a layer of trust. That trust didn't come from winning. It came from knowing I could handle being wrong without spiraling. Mentally, the biggest shift was accepting that disasters don't disqualify you from this profession, but refusing to learn from them does. Every long-term trader I respect has a similar history. Not because they're reckless, but because markets eventually find everyone's weak spots. The difference is not who gets hit, it's who adapts. Once I stopped treating disasters as proof of failure and started treating them as diagnostics, they lost their power to define me. Over time, something subtle but important happened. My relationship with risk changed. I stopped seeing risk as something to conquer and started seeing it as something to coexist with. I became quicker to reduce size, quicker to step aside, slower to get excited. That didn't make trading dull, it made it sustainable. The emotional highs and lows flattened out, and in that flatter emotional landscape, decision quality improved dramatically. Looking back now, I can say this without hesitation. My worst trading disasters were also my most valuable teachers. Not because they were dramatic, but because they forced humility, where confidence had grown lazy. They taught me that survival is the first edge, discipline is the second, and profit only comes third. If you keep those priorities in order, recovery is always possible, no matter how bad the damage feels in the moment. And that's the lesson I want to leave you with. A trading disaster is not the end unless you let it be. It's a moment where the market strips away illusion and asks whether you're willing to rebuild on truth instead. If you are, you come back quieter, steadier, and far more dangerous in the best possible way. If this story resonated with you, I invite you to subscribe to the channel so you can continue learning from real market scars rather than fantasies, and leave a comment sharing the hardest trading lesson you've had to recover from, because naming it is often the first step toward turning it into strength rather than baggage you carry forward into the next cycle.